Thursday, August 29th. Here we go. We had some news. ECB, what's the driver? If you are trading, it means you're in a car. You like to know who the driver is, right? US China, FOMC. Well, at what time was it, guys? At about right here, 9:35 Central. Do you know what hit the fan, right? Pretty bullish day. There were some other things we were going to talk about, but this came out just after 9:30 Central AM, and they slammed them from like 18 all the way down to 06, and then grinded back and had some resistance. Now, at the time, it was an ECB report that one of their officials, one of their governors, had said from the Netherlands that they weren't going to be, or QE wasn't necessary. He felt that the markets were overshooting some extra QE at their next meeting in September. So that's bearish for stocks because they want QE. ECB is our Fed for Europe. And so when they don't get what they want, stocks go down and bond prices actually go down too to price in higher rates. It's a hawkish comment. So that's bearish. But funny thing happens. There were a lot of people that sold it there in the market and sold it here on the way down, and the market uses those as resistance, including ground zero, as we call it. Where does the market start? And it was around 17, 18. That's why it was good resistance until they got through it. Then it became good support. Ground zero is where the market's price is before good news hits, especially not good news, when news hits. Where the market is before news hits, whether it's good or bad for the market, especially if it's surprise, if it's a surprise, unscheduled. The fact that the market came all the way back to ground zero, so broke down, came all the way back, and then some, shows that this continuation is not a surprise. We talked about that here, not here. And we could continue to walk and grind up all day long. There was some great strength, gap open higher today. This weakness was shook off, and it's like a beach ball underwater when you can't get a market that should go down and does not. That's a clue. The market's price was lying and just got cheap in here. Now, I thought, hey, this got a chance to retest the lows. This was resistance. We talked about that being resistance. When it doesn't and it starts to climb up, all bets are off when it gets through where it started. And you begin to put horns on or question the bearishness. But that's a clue the market gives you, because it would have never done this, right, had it not been for that story. So let's look inside the footprint, or Sierra calls them number bars. Let's go back. It's kind of like under a microscope. What did the market look like in real time? Here's this big down bar. Forget about all these greens and reds and all that noise. Shows you the speed at which we went down. Now, we don't break if this negative piece of news for stocks doesn't come out at around 9:35. But if you look, you might not be able to see this, but you're going to just trust me on it. There was a lot of volume that came out at 14 and 15, which means there's a lot of people who got short. When you get short, you now have to buy it. I'll talk about this in a different webinar or different video. But that's why this 14, 15 area was initial resistance. There was also some good volume when the market comes out all in here. That's where it becomes ground zero. Where the market started was around 18 even. Point is, where there's good volume, 400 there, 400 there, the market creates overhead resistance because the shorts cover into where they got short. So it's no coincidence that the market walks back up to 14, 15 in here, lays the top of that consolidation. Don't forget that. Know where your levels are. Always work on trying to determine where there might be open shorts and open longs, because those prices matter. And that was the story today, and why it's important to be in a room like mine, to be in my room. It's not just real-time analysis on what price might do. It's analyzing news real time, because that's where the juice is.